traders, Philip Tagerson here from Stock Market Strategy. Before I start, I just want to say that trading involves risk and hard work, so please do your own due diligence before trading for real money. Today I'm going to talk about double bottoms. I will explain the requirements for this chart pattern and how to spot them. Furthermore, I will explain the psychology behind the pattern and in the end show you how to trade the double bottom. If you go to our website www.stock-market-strategy.com, you will find a tab called Education, Chart Patterns and Double Bottom. Here you will find a written explanation including two charts, one showing you how to spot the requirements and the other one how to trade the double bottom. Double bottom is a reversal pattern, meaning we'll be looking to catch the beginning of a new trend. The double bottom is a real-time tool, whereas an indicator is lacking, making this chart pattern very popular. Besides that, it's also easy to spot. I like this pattern because I understand why it works. It uses psychology in trading because you can see when other traders are in emotional and financial pain. Here's an example. You see this downtrend. We're seeing lower lows and lower highs. Here's also a lower high. Traders will go short here. It drops and they expect it to make a new low because that's a downtrend. But it doesn't. It makes an equal low. Suddenly it gets rejected and starts climbing. Over here now they're underwater. These traders over here are losing money. They're feeling the emotional and financial pain of losing. So this setup feeds on other traders who's losing. It's a very powerful setup. Here's the requirements for the double bottom. First, an established trend. It needs to be in a downtrend prior to the double bottom, otherwise you cannot reverse any prior trend. This is a reversal pattern, so important. Here you see the first move down. It moves up and creates what we call the neckline, this peak here. Then it comes down and forms the second low, making the double bottom. This low here can be slightly higher or slightly lower than this low. And here's the most important thing, is that you need to see this resistance be broken and close above. Before it closes above this resistance, it's not confirmed a double bottom. For example, if this one got rejected and dropped here, people would just out in the future say, well, we had sideways price action in a downtrend. So it's very important that you wait for the confirmation. It closes above the neckline before you can call it a double bottom. Over here you see something which we call support. It's because what were resistance is now support. It's very normal to see a pullback to test that area. Okay, double bottoms can be used for both analysis and trade entries. I'll get back to the entries in a second, but first let me show you how to analyze the market using double bottoms. Here we got the chart of SP 500. We see that we had a downtrend, so hopefully we were not in any long stocks here. We probably taken our profit and be happy about that. Then we see the market form support. And as the rule says, when it closes above that peak, the neckline, we got a trend reversal. So when we see this trend reversal, this double bottom confirmed, we can start buying stocks again. So by using this double bottom, we will always be on the right side of the market. Here's how you trade the double bottom. There's three different places for you to go long. The first one is aggressive trade because you assume it will be a double bottom down here. It has a good risk to reward but a low hit rate because it will often continue down and not turn into a double bottom. And the confirmation of the double bottom at first happens here. And that's why you got your second opportunity, a close above the neckline, which confirms the double bottom. It's less aggressive. You got a high hit rate, but your risk to reward is not as good. The third one is over here, when you got a pullback to the support. It has a high hit rate and a really good risk to reward. The problem is that you don't always get the entry. Like in this situation, it doesn't really pull back enough to the support, so you will be missing this trade. Okay, now you know where to go long, but let's look at the specific entries. Over here on the first one, I'll be using this bar because it's a bottom tail and it catches people on the wrong side. It opens here, then drops, but then on the same day it climbs and goes up and ends positive. So it's called those people on the wrong side, adding fuel to the rocket to the upside. And you also see that the day after, big momentum bar, because a lot of short covering. The second over here is more by the book. It's simply just a close above that neckline resistance. It's this bar here.
And the third one, though it doesn't come all the way to support, you might change your rules saying, okay, it's okay because it comes back here to this area as well. So if that's what you do in your trading, here's an example how to enter it. Here we got a bottom tail as well. It opens here, goes down, and then goes up again, catching the people on the wrong side. And we're seeing that the day after here, it catches people on the wrong side, they have to short cover. This ends today's video. I hope you enjoyed it. Remember to subscribe to our channel so you don't miss out on future videos.